Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the Miami Exchange ETF Conference, we have Phil Mackintosh, Chief Economist at Nasdaq. We're going to take a look at ETF fund flows and see what that discerns in terms of macro themes. Phil, it's great to see you from New York to Miami. Here we are. Let's start with the macro. What can you discern from the fund flows? Where are people putting money in and out of?
Yes, it's been interesting. One of the things we've been looking at all last year was retail fund flows, and looking at retail trading in stocks. We've actually seen, as the market sold off, retail was selling stocks more and more and more. So they focused on selling tech stocks, healthcare stocks. But when you look at the ETF complex, every single month was net to buy of ETFs. So retail definitely like buying ETFs, whatever the flavor, and they've been selling net stocks. When you look at the ETF trading, around about a third of all of the trading that retail does is in ETFs. And yet all of that adds up to just 5% of the daily value trading in ETFs, because the complex of ETFs is just so liquid.
What themes are you seeing growth in, and is there an uptick in actively managed funds?
Yeah, so there's almost two questions there. And if you think about 10 years ago, index products were mostly what ETFs were about. In the last 10 years, we've seen the SEC approve active funds. So there is actually like proper mutual fund stock selection in ETF format now. And that is, to your first question, one of the things that the retail investors are starting to buy into. It's like replacing their mutual fund investment with an ETF that's still actively picking stocks, but is an ETF, so it's liquid, it's trading every day. The other thing that we've seen a lot of sort of activity in, and maybe more fast money, is in thematics. So there's a lot of ETFs. You can buy water, you can buy airlines, you can buy online retail. And so we've seen, as the COVID cycle of hitting COVID, coming out of COVID, now we've kind of got inflation and interest rates. There's ETFs for all of these thematics. And so people, when you see that thematic, you can actually buy a portfolio with one trade that exposes you to that thematic, whether it's rising rates or inflation.
Which ETFs does retail like the most?
Which do they like the most? So in terms of notional flow, they still do stick with some of the big products like the QQQs, like the SPY, like the AG bond ETF. So the very broad market products still probably get the majority of the inflows. But what's more interesting is looking at the thematics and the people that are actually sort of sharpening their pencils and trying to work out how do they beat the market. Because that's the thematic products and some of the value growth style tilts you can put on your portfolio with an ETF as well.
Let's take a look under the hood a bit, right? How ETFs are constructed, because they really are stocks and portfolios. How are they different?
Yeah, it's a really good question, right? So they're a stock because, like QQQ, it's a ticker, it's got a bid and an offer, you can trade that all day using your online brokerage account. But under the hood, the QQQ is a portfolio of 100 Nasdaq stocks that's managed by a portfolio manager. And so what's really cool about ETFs is that there's market makers and arbitrageurs that can work out the value of the portfolio and price the QQQ so that it's basically the exact same value as the portfolio. And that's really important for some of the less liquid ETFs, because what it means is the liquidity of the portfolio is available via the arbitrage mechanism and the market makers for any investor to buy. So just because you look on the screen and you see an ETF price with no trades doesn't mean there's no liquidity. There's all the liquidity of portfolio underneath, and it will come to the surface really quickly as soon as you create a trade that creates arbitrage into the underlying.
So in the article, this piece where I got that question from, you referenced an LULD ETF.
Yeah.
What is that?
Well, actually, LULD is limit up, limit down. It's a pretty nerdy technical part of the market, but they are guardrails around the price of all stocks in the market. And the idea is limit up, limit down is meant to stop a stock from trading down too quickly or up too quickly because of a fat finger or some kind of an error trade. And so the thing about the way that they're structured is limit up, limit down is set off liquidity. So a less liquid stock typically has less eyes on it, and so the regulators gave it a wider guardrail. The problem for ETFs is we know ETFs are also liquid portfolios that price very effectively by the arbitrage mechanism, and so technically they shouldn't need the same wide guardrails. They could deal with much tighter guardrails.
Appreciate the insight as always. Thanks for joining us. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.